Hi, this is Randy Finney with Right Side of the Chart, and today's Monday, September 25th, 2017. I wanted to do an update on gold and GDX, the gold mining stocks, and in doing that, I usually incorporate my analysis on the US dollar into my outlook for gold. In doing that, I often use this chart here. This is the Euro US dollar pair, so it compares the euro to the US dollar. The euro is by far the largest component of the dollar index. So by just tracking this chart, if the euro is rising against the dollar, the US dollar index is almost certainly falling. Likewise, if the euro is falling against the US dollar, the dollar index should be rising. The Japanese yen is the second largest weighting in that index, which is it's actually a distant second compared to the weighting. The euro, I think, is nearly two-thirds or something, well over half of the dollar index. So I like this chart, and it also shows you this currency pair trades nearly around the clock, so you can see you're not going to have the gaps here like you do when you try to trade or track an ETF or an ETN that tries to mirror the dollar index, such as UUP, for example. You're going to see a lot of gaps there. Now, I wanted to clarify this. I did make some comments on that post, the last update on September 19th, so not even a week ago, where I gave the near-term outlook for gold. I thought that, gold was ready to bounce and the miners along with it. And I had erroneously stated that a break of this trend line, I showed this same chart here. It's a daily chart of the euro US dollar pair. And I had stated that a break of this would be bullish for gold. Now, my head was screwed on backwards. That was just about the time right before we got our power turned back on. I was working off generator power, working in, it was 90 degrees plus in the house. Crazy. And it was, heat index was over 100 outside right after hurricanes pass. It's usually very hot. That's been my experience. So, either way, I wanted to clarify that. I did clarify it in the comments section, but that didn't, so far, that wasn't the case today. Ironically, those incorrect statements that a break of this line would be bullish for gold hasn't panned out. Gold, the euro was down about 0.75% today against the U.S. dollar. Of course, the dollar index was up. Yet gold also had a strong day. And I want to say this, that the inverse correlation between gold and the US dollar, meaning the dollar falls, gold tends to rise. You can go back many years on a long-term chart and see that that inverse correlation. There are times, it can be days, weeks, and I've even seen months where there's a disconnect in that relationship. So it doesn't always hold constant. I'm going to give you two views here. Um, it is somewhat contradictory analysis, and therefore my bullish outlook for gold does remain. However, it is tempered at this point because of this. So we have a breakdown today of that trend line that I highlighted. You can see a very impulsive candlestick that confirms the validity of that trend line. When you have a breakdown, you see a little slight move above or below a trend line, not very convincing. But when you have an impulsive move like that, it helps to validate that trend line, show you a lot of eyes were watching, and the sellers stepped in certainly once that level was broken. Now we did close so far. We're trading just above. Remember, this trades around the clock, still trading just above support right here, and that's about 118 or so. So there's some horizontal support and there's a lot of possibilities. Now, we had the negative divergence that preceded that. We had a divergent high, preceded the breakdown. That tells me that more than likely we're going to go lower. How low? Hard to say. I've stated in recent weeks that any pullbacks in the euro, at least for a while, were likely to be shallow, and that was the case here since we had a breakout. I'm going to get to that breakout in a second on the long-term charts, but we have a support level here about 117, and I could see the possibility coming back all the way in here to about the 115-ish level. And there's of course there's a myriad of possibilities. You could have a kickback rally here to back test and then move on lower. Either way, support is support. So we watch first this level here where we're at now, around the 118.5 level. If that goes, then you look at any of these targets. But right now, we can't rule out a back test yet. And maybe gold is sensing that. I suspect that today's move in gold was largely, if not exclusively, a flight to safety because the large cap, namely the tech heavy leading index, market leading Nasdaq 100 and the big FANG stocks, they all were down today quite a bit. They recovered some of their losses at the close, but they still closed down about over a little over 1% on QQQ. So that's where the hot money's been, chasing those names for a long time. So we're starting to see that call it bubble, call it whatever you want, that pocket of money start to deflate right now. And so I think we saw money move into gold today as a flight to safety, because it's unusual to see, a considerable drop like this in the euro against the dollar, or other words, the dollar rising as it did today, and yet gold was still up. So that's what I'm looking for. And again, this tempers my bullishness for gold, because if anything else, even if this disconnect, even if there is a disconnect between that inverse relationship between the dollar and gold, a falling dollar, I'm sorry, a rising dollar, which would be a falling euro, is very likely to provide headwinds to a trade in gold, a long trade. Now here's that long-term weekly chart, 10-year between the euro US dollar pair, and this is that basing pattern. This is a very, very powerful, I've talked about this quite a bit, a multi-year, nearly 3 year long basing pattern here, and we had a breakout, and that's where I stated, because this was so powerful. You had a divergent low, bullish divergences confirming. That's where, at least a few weeks back, I was of the mindset, and I'd stated on the site, that any pullbacks were likely to be shallow. Now we're looking pretty overbought here. In fact, we're as overbought as we've ever been, at least in the last decade, on the euro US dollar pair. You can see some extreme readings, both in, persistent. We were up there overbought for a while, at least a couple months, and we hit almost a 78 level. And you see, you go back in time, the red line is overbought. And, again, this isn't a buy or a sell signal in itself, but it's a pretty good guide when you see these overbought readings. I'm just circling the levels that when we've had that 70 level tag, the red line, and you can see what's happened in the past. So here we go. We had a top here, major top. We had a major top here, and each one you can see that might not look like much, but that's a significant correction. That's again a weekly chart going back 10 years. So there it is. So it just tells you, in this one we might have come, that overbought reading came there, but we had a divergent high. So what happened? Prices kept coming up, and then we had some negative divergence there following that one. So that's, from my experience, you either get these single tap overbought readings and then a correction or a top, or you get an initial tag of the overbought reading. The RSI comes back in, thrusts up to make a lower high against prices making a higher high, i.e. negative divergence, and then that marked the top there, and that marked that huge slide down there. So um, what I think might happen here, this is my guess. I can see the PPO rolling over, so now I'm looking for a more sizable pullback, and it's probably going to target that 115 level. I talked about this recently. We have the top of this basing pattern is roughly right here, around 115, and that's also that target that I showed you on the daily chart a minute ago. So my preferred scenario would be a pullback to that 115-ish area, and then a continuation of the rally. We might go up, maybe even put in another high, and then come down again. That would put in negative divergence here. I can't look this far ahead right now. I'm just looking near term, and I see a lot on this chart. I see an extreme overbought reading. I see the PPO rolling over, poised for a bearish cross. And you can go back in time and look what happened before when we had these bearish crossovers. They work as pretty good sell signals. So there it is. I'm near-term bearish on uh, the euro, which means I'm near-term bullish on the dollar. Looking for not much. We're only talking about a little over a 3% pullback, and maybe the dollar shrug, or maybe gold shrugs it off, maybe not. All right, enough on that. I wanted to spend a lot of time on the currencies because I do think it's important. Now, if we look at the charts of gold and silver and GDX by themselves, it looks pretty decent. Like I said in the last update here, this appears to be a run-of-the-mill pullback. We were extremely overbought. You can see this run that we had here, this rally, huge advance. That's one of the strongest rallies gold has had. It is the strongest rally so far this year. Well, this one might take the cake. There was a correction in between, but either way, it rivals this one right here. We had a big rally back. Started actually in late 2016 and went into early 2017. So you can see this rally has is the one that we recently had exceeded these two previous rallies. This one didn't have a divergent high as these two did. And so it needed to come in. Gold prices needed to come back in. We were quite overbought right here. And I mentioned the other day in the last update, one of the things that I was looking at is the PPO remains bullish right now. As long as it's above the zero line, especially this signal line, the 9 EMA, the trend is bullish. So maybe we come back a little bit more in gold, maybe not. The correction could be over. I also noted some horizontal support right here. If you look at these two previous reaction highs, we have a big gap back here. So taking all that together, gold pretty much bounced off that support level, put in a quite a bullish candlestick today. There's no arguing that big green candle. So like I said, I'm not gung ho bullish on it right now. If you want to be long or you're already long, consider a low, a stop below the recent lows right there, about 122.50, because that big green candle should not be taken back anytime soon. Otherwise, that would be bearish. So there's gold, and let's just look at the other one of the other shiny metals. That is, here's silver via the SLV, and you can see right here, it's 1592. I have a support level. I've had this level here for quite a while. It catches a lot of gaps and reactions to the left, as you can see, and so far we've we moved impulsively off that level today. Again, big bearish, I'm sorry, bullish engulfing candlestick. Let's see if there's any follow up there. Trend indicators are still bullish in silver. So, like I said, in a vacuum, if I only look at the charts of the precious metals and the miners, they look good to me. But that pullback in the dollar, or rally, I should say, pullback in the euro, rally in the dollar, that might give some headwinds here. This is GDX. Here's a bearish, no, I'm sorry, bullish falling wedge pattern, downtrend line. We had a breakout and a back test. Again, this chart was covered quite a bit. So very, very bullish price action in GDX. But again, like gold, it got pretty extended on this rally, went up here to challenge those previous reaction highs, pulled back in, and again, it looks like a healthy correction so far, considering that move and how overbought we were. You can see we were overbought here. The last time GDX was overbought was all the way back here in February after that huge rally there. And it needed to come in, and it's worked its way sideways for a few months. Now, bigger picture is this. I think if we look at this, here's some sideways consolidation. And this is really the bigger picture. If we break above that range, that's going to be bullish and more than likely take us quite a bit higher. And I would expect at minimum challenge those highs from back in 2016, maybe more. Of course, a downside break would be bearish. You can see there's quite a few reactions there. So let's see how this range resolves itself. Now, keep in mind, you can certainly swing trade within this range, um, but it's likely to be a choppy trade until we get a definitive break one way or the other. So that's the bigger picture on GDX. Near term, like I said, the charts look good. They look constructive for a bounce, especially after today's move. But if this was a one-day wonder, a flight to safety that doesn't continue, um, just don't let your stops get out of control if you are long or you're considering going long the mining stocks. And I'll just wrap up with a 60-minute chart, and we'll keep this one short today. This was in that last update from the 19th. This was the descending price channel, these two yellow lines, and I stated a break above that price channel would be buy signal number one, with the first target or resistance level here at 24.15, and we needed to see a break of that for a second and higher probability buy signal. So we did break above there. We ran right up to that 24.15 level, which was resistance, and we failed. We never had a 60-minute breakout and close above it. You need to see at least a 60-minute candle close if you're trading the 60-minute chart. So we fell back, went back within the channel, hit the bottom almost perfectly. You can see that. I have not modified these lines since that last update. And then we went on and we broke out again. A little bit sloppy price action to see a breakout, falling back into the channel and breaking out again. Either way, each of these lines are resistance levels, and I still maintain we need to take out this 24.15 level for a higher probability buy signal. There was a little bit of divergence here. You can see that at the lows, but I put a higher weighting onto what gold and silver are doing than I do GDX in itself, because ultimately they're going to follow the metals. You're not going to see GDX rally and take out these highs without gold taking out the previous highs. So keep them both on your radar, and of course keep the dollar index on your radar. Um, and sometimes you can just trade gold for what it is and GDX for what it is. Um, we might not see any strength in the dollar in the coming days or weeks really have an impact on gold and GDX. It all depends on what the market does. Again, if there's money, because the one thing about this market, and it's been the signature of this market for the last couple of years now, is sector rotation. There's a ton of money. Even though the Fed's going to start to withdraw some of that excess liquidity, there has been an unprecedented amount of liquidity pumped into this market. And the one thing for certain, it's going to find a home. The Fed isn't going to pull it all. They're not going to pull the rug out from under us right away. So there's a lot of money sloshing around this market. And if it needs to move out of large cap tech stocks into gold, that's where it's going to go. If it's going to go into commodities, that's where it's going to go. If it's going to go into defensive issue stocks, that's where it'll go. So we just have to watch and keep an eye on each sector, and then try to get in front of it, get in, get out, and move on to the next one. All right, we'll leave it here. This has been Randy Finnan with Right Side of the Chart. Hope you enjoyed it.